I'm at REITWise 2013 NAREIT's Law, Accounting, and Finance Conference. Joining me today is Marti Tirinnanzi, Senior Vice President of TeraExchange and a Board of Director with Community Development Trust. Marti, thank you so much for joining us.
My pleasure.
I'd like to ask you to start by laying out for us the overall health of the derivatives market now that we're in a post-Dodd-Frank world.
Well, I'd like to say that the market is improving, but it's in transition right now. It's going from an opaque market that was once controlled by a few large banks to one that's more of an open marketplace that offers price transparency and also offers the benefit of mitigating counterparty and systemic risks. Very important. It's a market that all market participants can have confidence in, which is a really good thing.
Could you briefly define the differences between the OTC bilaterally swaps and the CME centrally cleared swaps?
Okay, so bilateral is where you are actually executing a trade with a bank counterparty. First of all, it's going to be risky in post-Dodd-Frank world, and it's going to be expensive. I think that executives and directors should be mindful of the fact that there is a change in something called too big to fail, that the administration is departing from that. And when I was working for the Federal Housing Finance Agency and responsible for with the transition to central clearing for Fannie Mae and Freddie Mac, we recognized this, and we felt that it was too great a risk for the country to endure. With centrally cleared, two things you need to know: it's safer and it costs a lot less.
Could you elaborate a little bit on the benefits and the costs of both approaches?
Sure. First of all, the greatest benefit is that it's a true market where participants, REITs, get to see the bid and ask on prices. It's also effective risk mitigation, and I think something else that REITs will like a lot is that you don't have to deal with ISDAs or CSAs anymore. The biggest cost and great concern for a number of companies is just the posting of margin. It's a cost to protect the company from risk, and I think that that's something that we should keep in mind, and that everyone posts margin. So that's a leveling of the playing field, and it's also establishing a capital buffer in order to sustain and create confidence in the market.
What changes do you expect that we'll see related to the derivatives market in, say, the next 12 to 24 months?
I think that the best way to put this is to remember the time when you used to call your stockbroker and buy stocks. You don't do that anymore. None of us do. We go online. We buy our stocks online. We get to see prices. We execute confidently. Within seconds, we know we've bought those stocks. And we can do it anonymously. We have a relationship with our bank. The stocks are paid for. This is where I see the derivatives market going. That level of efficiency is coming to bear in this market. And I think that it's going to happen within the next 12 to 24 months because of Dodd-Frank. TeraExchange, the company that I'm with, it's where you can buy a swap from your desktop. You know, it's fast, it's easy, it's cost efficient, and I think it's going to help the market move to that position much more quickly.
Marti, thank you so much for shedding some light on the derivatives issue.
You're welcome.
For more on this and other REIT news and analysis, be sure to visit REIT.com.